Hi and welcome to Dominating the Market in Uncertain Times Part 2, where we're looking at Tony Robbins' book Unshakeable. As a follow-on from Part 1 of this video, which looked at the 7 freedom facts from Tony Robbins' 2017 bestseller Unshakeable, here we delve into the core 4 principles to apply to all of your investing. As usual, Tony Robbins uses market data and analysis, as well as his unbelievably effective communication style of breaking things down into understandable chunks and to really give any investor, new or experienced, the confidence to dominate in the financial markets at any time. So in the last video, the 7 freedom facts should have helped you ease your anxieties and fortify your resolve in investing, especially at times when others may panic. And now we'll look at the core 4 principles, which are the blanket fundamental behaviours and traits applied by the world's top and most successful investors. So let's get straight into the core principles. Core principle 1, do not lose. Now this sounds unbelievably simplistic and also impossible, right? But the emphasis is to hate to lose and do everything you can to avoid it, even more than your desire to win. In Unshakeable, there's a large emphasis on long-term investing over diversified markets. Diversified markets means that your money is over lots and lots of different areas. So in downturns, diversified portfolios mitigate lots of risk. And because we know financial markets all ultimately grow, think back to the freedom facts, so will your money over time and in a far more protected way. This approach is backed up within the amazing book Hedge Fund Market Wizards by Jack D. Schwager, where nearly all of the people he interviews, and they are all world-leading traders, will talk about diversification of portfolios and managing the downside more than anything else. Schwager's book even takes this a step further by saying how this can be achieved in shorter-term markets and investments. A simple tip within the book, for example, is that even in futures and indices markets, gold and bonds are often bought in downturns, as behaviourally they're great bear investments. When stocks go down, gold and bonds generally go up, so they're a fantastic way to mitigate risk in the most uncertain times. There's also another fantastic tip in the book, Hedge Fund Market Wizards, about how to mitigate your losses in short-term markets like futures, and that is testing your hypothesis. What I mean by testing your hypothesis is that when people trade, they'll put a trade on in the market based on their view of technicals and fundamentals, or maybe it's just a feeling about where the market will go, and they believe that their hypothesis is right, even when the market goes against them. In the book, it talks about discipline around your hypothesis. So you need to set a level which will test your hypothesis if it goes offside, and you have to be ready to walk away if it breaches that level. So if the market goes against you, you can't be romantic and stay in the market thinking that you're right, which I see a lot of traders do, but instead you come out of the market, you walk away and you think, I got this one wrong, you learn from it, but you come out before you lose a lot more money. You don't trade to your pain threshold, you trade to your hypothesis threshold. This type of learning will really help you limit your downside and maximise your upside, and it will also teach you the discipline that you won't always be right and that you walk away and you can go on and move on to another trade which will be successful. Okay, so now we move on to core principle 2, which is asymmetrical risk reward. Now all this really is a fancy way of saying make sure the odds of reward versus risk are stacked in your favour. The belief that only large risk brings large reward is absolutely untrue. By investing long-term in diversified markets stacks the odds in your favour of positive returns. For example, in a 2017 risk analysis of investments over 40 years by the finance website NewsWallet, it showed that over a 40-year period, you've over a 99% chance of at least coming out with your initial investment intact, and a 95% chance of at least earning 3 times your initial investment. Now that is the power of protecting your money in diversified markets and compounding your money over time. In his book Unshakeable, Tony cites Paul Tudor Jones' 5-to-1 rule for risk in terms of investments as a basic start point for looking at your asymmetrical risk reward in any trade or investment. Okay, so let's move on to core principle number 3, which is tax efficiency. Now I get that this isn't a sexy subject, but for any savvy investor, taxes play a huge part of your net or actual takeaway. Don't be blindsided by the gross returns if your tax affairs aren't efficient. Taxes can wipe out a third or more of your returns if you're not careful. Tony does go into far more depth, but the basic rule of thumb is that it's not how much you earn, but it's how much you get to keep. So get your affairs in order and take advice. This isn't encouraging any fraudulent or illegal actions at all, but merely saying that, if managed properly with good advice within the existing laws, managing your tax efficiently can be a huge factor in what you keep and ultimately on how soon you might be able to use that pot to sail into the sunset. Okay, so let's move on quickly to core principle number 4, diversification. So without diversification, your risk is simply not managed long term. It's been a constant theme in these videos, and it's a constant theme throughout the book. By diversifying your trades and investments across different variables, that could be different periods of time, different types of world markets, types of companies and assets, different geographical markets, that means markets in different areas of the world, your bets and investments are far more stable, and as previously shown, you've less than a 1% chance at the end of 40 years investing like this to take away less than you initially put in. In fact, you've a 95% chance, or in other words, 19 out of 20 chance over the same period of time to at least triple your original investment. So take this advice and diversify your investments over time and let the money keep compounding. Irrespective of your background, job or income, you can commit to long-term investing. Even if it's 5, 10, 20 or 30 years, your chances of walking away with a lot more than you put in and being able to retire early are dramatically increased. There's an absolute wealth of information on YouTube and in books, so model what is being done by the financial masters. And if you can, read Unshakeable. It is a book that, if you apply it, will change yours and your family's lives and fortunes. So that's it. You've got the tricks from Unshakeable by Tony Robbins. It's an absolutely fantastic read, so go out there, invest and be safe. Listen to the principles and follow the rules from those that are the best in the world. I want to thank you for taking the time to watch this video. It's been narrated and made by the Success Mindset YouTube channel. In the words of Tony himself, make your life a masterpiece. Thank you very much for listening.